sit. All right, so I think it's pretty well known that gold has had an interesting year. I guess wanted to kick things off asking the panelists, where do you see the price of gold moving to in 2020? If you want to start, Felix, and then we can work down the row.
Sure, I think we have pretty bullish expectations on the gold prices. I think we're expecting gold price could be about like hitting over 1,600 next year, and potentially going to back to the close to the previous peak of potentially 1,800 by the end of next year or early 2021. I think that the driver is mainly on very simple, because gold is basically investment demands and is still pretty much being perceived as a risk-averse asset. So it's all driven by the currency and the interest rate.
Well, the short answer is the gold price, I think, is going to go up next year. But again, the million-dollar question is by how much? And I suspect that with the ongoing global economy, for example, the US, while they are already starting another round of quantitative easing and cutting interest rates, we can't deny that the economic fundamentals in the United States is still much better than other regions like EU or other major regions. So in short, while I think that the US dollar gold price will continue to go up in the long run, I suspect that next year it may continue to underperform the gold price in other currencies like in euro or in other like emerging market currencies. And right now, I think the gold price is having a price consolidation. I was actually able to forecast it will see 1,500 earlier this year, but my initial prediction was the gold price would like touch slightly above 1,500, and then there will be a massive profit takings and price consolidation, but it didn't happen until the most recent few weeks. So right now it seems 1480 is pretty strong support, but it could possibly, the gold price could break below that level, especially if the United States and China could come up terms on the trade front. But I think personally it is a very good time to start accumulating gold during this consolidation period.
So what I'll do is just maybe rather than give my views, I've got a sort of a collective wisdom view from the industry. Every year the London Bullion Markets Association, which is the one that oversees the auctions, twice-a-day auctions, they have a global conference, and this year's conference just got over last week. And during the conference, they conducted a survey to try and get a view on gold, silver, platinum, palladium prices. And this conference is attended by most of the prominent research analysts, mining companies, bankers, refiners, processors, etc. So collectively, the view of those 480 participants was that they projected gold prices over the next year to be going to go up to a level of $1,666. So that's the view of the industry, and so that's the best I can say.
And moving on from that, where do you see gold mining investors putting their money this year and looking ahead at next year? What are are there any kind of really interesting projects or countries or management teams that are coming up as kind of interesting things to watch?
Maybe I'll start. Sure. I think earlier in the year, or probably earlier in the year, what was quite apparent was the divergence of gold prices versus mining stock prices, as mining stocks. And I think at that time, people pointed out the fact that there should be a rebound in mining stocks, which has happened. Right now, the generally accepted view when you talk to analysts is that this is now a stock pickers market where people need to look at the management, need to look at the kind of properties that are out there, and then select particular stocks rather than look at a more industry-wide kind of approach to stock picking.
Well, I can't really, my standpoint to point out one or individual companies, but I kind of generally agree with what Sunil has been talking about. Is more on the bottom-up stock picking approach. But generally, gold price is pretty much driven by gold prices and volume. First, very simple basics 101. And it depends on who gets basically more volume. And what I do think will be interesting in the coming years is after the massive acquisitions that we're going on in the bigger guys, we are likely to see more of these M&As driven stories in the next, at least for the rest of this year and probably next year. I think this is where investors will focus on who is getting the right balance sheets and hunger to add for more resources. And so I think M&A will be more like a key thesis rather than trying to pick individual stocks, because a lot of these mining companies, you understand that the production volume has been pretty stable, or some of them actually switching out resources, divesting from some really relatively lower tier assets and then try to shift to I think cost upgrade. So I think it's very difficult to pinpoint, but one thing that can probably drive the share price by region is, I think, take a lot of the companies more in these Asian markets or the Asia Pac markets, because it's the another play of the gold stocks is always apart from gold prices in the dollar, it's all by the currency. So it's where the currency depreciation's firm is starting to pricing in, then you probably see the stocks going to move.
I think the market is a little bit scared right now because I talked to many people like during this event, and many said, yeah, the sentiment is just so because everyone is scared about the the economic slowdown. People are afraid that there will be kind of stock market crash in the next maybe 1 or 2 years, and then like people are really cautious about buying equities, including gold equities. But personally, I think it is actually a very good time to accumulate gold mining shares, because I think the worst has been gone, like for the gold mining companies, because most of them have already undertaken huge write-offs back between the year, let's say 2013 and 2015 or 16. So probably like the overpriced acquisition, the bad asset write-offs are probably like all gone. Of course, unless the gold price falls again, but which I think is very unlikely. So I think right now is a good time to accumulate gold mining shares, especially like many producers, including the ASX listing producers. They have already seen some significant retreat in terms of the share price. And I agree with him said that as an investor, I will try to angle the M&A angle to look for opportunities, maybe even some development projects that have already established a little bit, a kind of sizable resource, and which is highly leveraged to the gold price. I think those are prime being taken over candidates.
Felix and Samson, you both mentioned the kind of trend of M&A that's been going on over the past year. Is there still a big appetite for the majors looking to buy juniors, or is what's the trend right now in M&A?
It depends on who, like who are the acquirers. I talk to regularly with some people working in the Chinese mining companies. So like obviously, due to the Chinese culture, they are all mostly looking for producers, producing assets, cash flow positive assets. And Well, in the local media, I'm sure that many of you have heard about IM Gold talks. It's already kind of meeting some kind of obstacles due to various reasons. But I'm pretty sure that right now the Chinese mining companies are still actively looking around the world, like not just Africa or Latin America. They are also looking for projects in Canada. For example, Shandong Gold, they have just established an office in Canada this year. So I think they're looking for projects worldwide, but for Chinese mining companies, they are more looking at sizable and producing assets. And for other like North American companies, I think they're more interested in like development projects, like not necessarily they're producing yet, but already maybe established some kind of resource size already, and then maybe the buyer will want to step up to buy other projects, step in, add some value, and to become a producer for themselves.
I think probably Samson have touched on most of what the situations I'm seeing as well. I think the Chinese in general is still having the appetite and are still finding hungry to get more assets, but it's more on the operation assets sizable. But at the same time, I do think there are also the non-government owned gold mining companies or mining companies in general, or even private equity looking for gold as a hedge of the portfolio. And those will be probably more interested to look into the medium-sized or small to medium-sized companies. We're talking about probably ticket size of below 1 billion, which have actually close to operating stages, very good resources, and more likely to be in places like Australia and Canada. Because I think those guys will be more risk-averse in terms of where the jurisdictions will be.
Yeah, I just to share, it's in terms of some of the North American majors. I think the managements are very cautious, given what happened in the last upcycle, and the shareholders have clearly signaled to them that you need to be careful before you go out there and start spending money. But over the last 6 months or so, with gold prices being at the levels they are, and the fact that the majors have been really very diligent in terms of managing their costs down. The net cash accruals are quite positive right now, and so over the next few months, I think the mindset is changing towards looking at more adventurous sort of investment, and I think you will see more deals coming out in the first quarter of next year.
One of the big investment trends that people keep bringing up recently are looking at the growing ESG concerns for investment, especially when it relates to the gold industry. What do you see are the implications to both corporates and investors of this kind of growing sentiment?
Yeah, I will start. I think I mentioned the LBMA conference last week. A fair amount of the conference was taken up with regard to ESG, and one of the biggest aspects where there's a lot of investment being made is to do with just the provenance of gold, and to see how the industry can deal with the fact that it's being tainted by gold from the wrong sources coming into the industry. And there are now several solutions that the LBMA and some of the key players are looking at, which involve technology like blockchain to monitor the provenance of gold that goes into the circuit. And I think going forward, everyone, from the mining companies, the refiners, to the actual consumers, are very much interested not only in looking for solutions, but actually investing in solutions and implementing them over the next few months, because the investors are increasingly, like you said, are asking questions about what companies are doing about it. So you will start seeing, at least as far as provenance, handling artisanal gold, looking at sources of scrap, etc., all those things will become much more transparent than they have been in the past.
Are you seeing a big kind of uptake in technological applications like blockchain across the supply chain in this industry?
Yeah,
then?
so there's several solutions which are out there that have been developed by the technology companies. Now we're at the cusp where industry groups are coming together and saying, look, let's agree on a particular technology or a particular couple of different solutions which we will all adopt, so that then it's easy to implement them. The key issue for something like a blockchain technology is the lack of interoperability between the technologies. So if one particular mining company or group of companies adopts one technology and then a group of refiners adopts another technology, the two can't talk to each other. So what the LBMA is now struggling with is to come up with some basic templates so that they can agree on certifying a couple of technologies, and then the industry can adopt those.
Do you see that coming soon, or?
That's there is an RFQ already in place for LBMA, and I think they were saying that early next year they should come up with recommendations.
Did you want to?
Yes, I think the trend is definitely there, and in general, it's been the ESG elements or the awareness is actually much higher in Europe. But what we're seeing is actually have more investors' demand coming from the rest of the world, especially in Asia, which is picking up. And I think in terms of the mining space, always being challenged, and it's also actually one of the cause of inflation for a lot of mining companies over the past few years is from the environmental elements of the ESG. But I think more importantly is apart from the E elements, I think more of the S and G has been underlooked. And one of I think the investors may not be feeling it in the moment, but I think more and more they're actually going to see the pressure coming from where the source of the capital is coming from. If it is coming from whether it's from private equity or from pension fund, then I think for the corporates has to react to where you source your gold and how you basically do the mining. So if it is like labor abuse or some sort of like safety issues that occur, it will probably hit not just about the operations, but the share price and the capital value that created by the management and the company. And at the same time, it will reflect it into the investors that invest in those companies. So I do think that for gold mining is also one of the relatively, I would say, uncertainty about the minings of the gold. So what I think will be impacting is for bigger companies, which like the top pages, they are quite likely that we will see more divestment from jurisdictions and countries where they see they have less transparency and there's more challenge by the investors at all. And at the same time, you have actually more investment. We were going back to the traditional jurisdictions, like Canada and Australia and North America in general, where you see actually investors throwing their money back into these regions, even though that the cost of productions or the time to get projects running probably higher, but is to get more transparency. And so you're going to drive how investors and corporates are going to behave. So I think ESG is something that is going to be very interesting, and it's going to be a trend that every mining companies have to look at, especially for the investors of the mining companies have to be aware of.
Does anyone have any additional questions or comments from the floor on ESG or any of the other topics that we've covered so far? All right. Sunil, you mentioned that you wanted to talk a little bit about kind of updates on the physical demand side, looking at both India and China.
Yeah, again, just to provide feedback in terms of the consumption markets right now, the state of the consumption markets, as most people would know, India and China together account for around 60% of global gold demand. China, the Chinese consumption of gold is around 1,200 tons, and India is about 700 tons or so. And so we've seen just to give you some context, India has been about 700 tons for the last 10 years or so, whereas China has seen demand increase from around 400 tons to 1,200 tons till 2015, 14, and since 2014 it's sort of plateaued off at these levels. And there's always concerns from the producers about what the demand outlook is like. The feedback that we're getting is, and I'll take each of the markets. So let's start with China. The feedback we're getting from China is that there's been a shift in the demand patterns. The large increase in demand that we saw earlier from 2006 onwards was really driven by investment demand. People were buying coins and bars and other sort of forms of investment gold, or buying into retail gold deposits, gold accumulation plans. So it was a lot of investment-driven demand, which saw a whole a wall of profit-taking in 2013 and 14 as gold reached its peak. Subsequently, what we're seeing is investment demand has fallen off, but it seems to have been replaced by actual sort of jewelry demand, some amount of industrial demand. So that's why you see the overall consumption remain around 1,000 to 1,200 tons. And I think the outlook going forward is similar. Recently, the investment demand actually since March, April has picked up once again, because you've seen retail investors have seen the price of gold go up. They've seen the renminbi depreciate. So there's been a move towards gold for investment purposes or for a hedge against currency depreciation, and that gets reflected in the increase in ETF holdings in local Chinese gold ETFs. So there has been a pickup in investment demand recently, but overall, in the last 2 or 3 years, there's also a sort of a consolidation of jewelry demand in China. So China has had a bumpy road in terms of gold demand, but I think the outlook remains positive, and I'll be fascinated to hear what Felix and Samson have to say about that. But as far as India is concerned, the Indian market has been soft this year. GDP growth has slowed, and that's getting reflected in slow consumption. And the outlook, frankly, for this year doesn't seem to be very positive. We will see a decline in imports. We'll see a decline in gold consumption. But we seem to have bottomed out. Next week is one of the biggest festivals in India, Diwali, which is traditionally seen as a period when people buy gold. But the feedback we're getting from our sources on the ground is that demand this year has been very soft. But the expectation is that the government has dropped interest rates, has reduced taxes, and has plans for a major fiscal stimulus this quarter, and that should ultimately spur GDP growth and increase demand going into next year. So while this year is soft in India, I think next year should be a little bit more positive. That's the feedback.
Can I add something on China demand?
Yeah.
Yeah. This year, China's gold demand has been quite soft as well, due to mostly 2 reasons. First is the poor economy. So the spending sentiment is quite soft in China, like not just on gold or jewelry, but almost on everything. And the second thing is the jewelry sector. Like they are moving away from producing traditional designs that are usually like in pure gold pieces. In most recent years, particularly this year, the jewelry fabricators are more pushing out new line products that are like so-called 3D hard gold, 5D hard gold. Like by looking by looking outside, like it looks the same as a pure gold piece, but actually because of the technique and it's hollow, so it contains much less gold than a pure gold piece. So from the perspective of consumers, they pay less because they are buying less gold content. And from the perspective of fabricators, their margin is higher because the cost of gold is much lower, right? So like the jewelry industry in China is shifting towards higher margin, contain lower gold contents on average pieces. So, and especially the Chinese government, the central bank, because they have to protect the yuan currency for the most of this year. We see that like in the first 8 months this year, China's gold imports have been like 380 tons less of gold year on year. So that is a massive amount of import reduction so far in the first 8 months this year. But looking at the gold price, the Chinese gold price is usually trading at a higher price than the LBMA price. But starting from around maybe August or September, the average Chinese gold premium has shrunk from around like between $14 and $20 US dollars per ounce premium to like between 6 and 10 US dollars per ounce premium. So like the import volume shrunk, but the premium also have been falling down. So that means the Chinese consumption has been quite soft this year. But this is actually the point I want to make is while both the Chinese and Indian physical demand has been weak so far this year, the gold price has been doing quite well, especially let's say from May to September, has been doing quite well. This is what happens when the actual market's point of view is different from the financial market because the financial market, like they realize the US is going to cut their interest rates, lower interest rates, more money supply. So many funds, they actually went to long gold contracts on the futures market. And so that's why we see the spike in the gold price. So while despite the physical demand have been quite weak in both China and India, but as an investor, I'm quite comfortable to be a contrarian to the general public.
I think both has been mentioned kind of good points. I do want to emphasize actually a lot of these gold prices movement is mainly driven by the investment demand, what we call, rather than on the physical demand. That's why I argue is because if you're just looking into physical demands everywhere, changes is very, very limited. And it's not really drive the gold prices because at the end of the day, it is where the investment demand based on the analysis is particularly on the ETFs and the financial products, which is where the offshore money of China actually is investing in. Sometimes I think the onshore money, when you look into it, it does miss some of the pictures because of the way the onshore gold has been transacted. So I think when you really look into the physical demand, investment demand from the financial product standpoint, it started to really react pretty positively after the June FOMC meetings. And that is how it changed to the investment expectations that we are going to turn from a rate hike to rate cut. So this is how the whole picture has changed, and that's how the whole rally of the gold price that we are seeing today started.
So there's been a lot of talk about how kind of the global political economic situation is affecting commodity prices. What do you see kind of looking forward? What's next for the gold market? Do you have any kind of?
I think there are two factors because of which there is sort of increased investment appetite into gold. One is, of course, the uncertainty with regard to trade wars, etc. So that flight to safety kind of push has happened, and we see that quite starkly that whenever you have a situation where the trade talks are in trouble, gold prices go up by a few dollars. So I think that's clearly showing that there are flows that are driven by this uncertainty. The second thing, which was mentioned even in the first session, earlier yesterday was the fact that the drive towards negative rates makes the case for gold even stronger. You know, gold for many investors, one of the issues for gold investing in gold has always been that with so many economies, so many currencies giving having sovereign bonds with negative yield. I think the case for gold actually looks much better than sovereign bonds. So we're beginning to see that getting reflected into the investment of gold, where people who would traditionally park their money in sovereign bonds, euros or yen or Swiss francs, who are now parking their money in gold, because at least it doesn't have a negative yield.
Yeah, I think I totally agree with that point. This is one of the reasons why I think it's important for investors to understand how the structure of their portfolio, if they're looking for some safety, but rather than investing in negative yield points, they're probably going to be invest part of the money into gold or something which is not negative, or at least no deductions of your interest.
To me, it's pretty simple. Like, if all of you realize that all the central banks in the world is going to continue to print money like there's no tomorrow, and continue to lower interest rates to continue to destroy the purchasing value of the fiat currency, what asset class would you choose to park your money at? Real estate is an option, but you know, like as real estate prices have been like skyrocketing in the last 10 years or so, many governments have increased the regulations to trade properties in their own market. So it's getting more and more difficult to trade real estate. And stocks, sometimes it depends on what kind of equities it is, but most of the equities depends on the economic growth. So like one of the more obvious and logical choice is precious metals, including gold, which has been acting as money since the civilization of human.
All right, going back to the floor, do we have any questions?
Could the panel tell us what's their view with respect to central banks buying? You've talked about the flight to safety. You've talked about demand in China and India. What about central banks?
Yeah, I'll take that. I think what we hear and see and anecdotally just sort of decipher from the flows is that the demand from central banks has gone up. There was a time, you know, at the turn of the century, gold was out of fashion among central banks. A lot of central banks were selling, as you well know, and what we're seeing since the financial crisis is a lot of the emerging market central banks have actually stated, from a policy point of view, that they will continue to acquire more reserves in gold. Some of the prominent banks, central banks, are of course Russia, but a lot of the Southeast Asian countries have been buying. China famously is buying, and you can see that in their numbers. I think their reserves have gone up almost 1,000 tons over the last couple of years. So all the central banks seem to be accumulating more reserves in gold. It's not a sort of a one-shot purchase. What we're seeing is basically it'll be 5 tons, 3 tons, 5 tons every other month, and it seems to be a sort of slow accumulation of reserves. And it seems to also be more of a portfolio diversification, that they don't want to keep, you know, they don't want to keep all their reserves in foreign currency. Plus, the issue of negative yields is also hurting them a lot. So I think in that sense, they are investing in gold. And also, interestingly, the gold is being invested in terms of physical metal, which is being held by them so that there's zero cost of storage or insurance. So yes, that trend is very clear.
Personally, I don't really think the central bank tradings of gold actually move the gold price. One simple fact, when a central bank going to buy 10 tons of gold, they have to pay the money that can buy 10 tons of gold. But when people participating in the futures market, they may only pay $1 to buy $1 to buy 10 tons, $10 worth of gold. So there's leverage there. I think it's mostly the leverage moving the gold price rather than like physical buying of the central bankers. But for example, if we look at the data that some would say that the global purchase of gold by the central bankers either is close to historical high or achieved historical high last year, is very telling. It tells that those working at central banks believe the system risk is increasing day after day, year after year. So I don't think the system will explode tomorrow or next year or in the short term, but it is in the making, the bubble is in the making, and it should pop sooner or later. So in the long run, when another crisis emerge, gold will be emerge as another safe haven asset. And this is one of the reasons why I am bullish in gold price in the long term.
I think in terms of the central banks or the sovereign fund accumulation of gold, it's very clear what their objective is, probably a diversification of the portfolio. That's why I agree with Sunil said. And the reasons I'm kind of not really buying into the leverage. That's why gold prices is moved by the ETFs and the investment demand. But I do buy that gold reserve accumulations by central bank is not really the driver, because one of the reasons is a lot of these central banks actually is not buying from the open market, and some of them actually directly buy from the miners. So the transaction itself actually is the flow itself is pretty intransparent. So it's not really the major driver, and they have been buying gold for the past basically 6-7 years, regardless of the movement of the gold price. So I think they are one of the major supporter to at best probably prevent gold prices from falling too much, because it drive a signal to the market what they believe in the longer term risk of the whole financial system or the banking system. So it is more about the risk preservation perspective rather than that they're trying to buy the gold prices up, and that's why driving prices up.
Do we have another question from the audience?
The word gold probably has been mentioned in the last hour for 1,000 times, but actually gold is not gold. And we have recently had quite a few cases where the integrity of the gold, even the world's largest bank found a lot of fake bars. So what do you think has to be taken not to undermine the credibility of, the gold and your story? Because even, ourselves received constant offerings of, discount gold, which is like, offering you discounted banknotes. It implicitly tells you something is wrong with the product. And do you think actually this fake gold, which is, I think, quite a lot, particularly here in Asia, that this undermines the credibility in the end product you have been mentioning so much in the last half hour?
I think it's a good question. So, and I think it's opportune that you've asked the question, because there's a myth. And let me tell you what the myth is. Yes, they were fake bars, but the bars had, the 1 kilo bars were 1 kilo of gold. So they weren't fake in the sense that there was anything wrong with the bar itself in terms of the purity or the amount of gold content in the bar. They were fake because they were not produced. The stamp was fake, right? So somebody had manufactured the bar, and stamped it to show as if it was made in Switzerland, whereas actually it was not made by them, and the way it got highlighted was because there were 2 bars with the same stamp. So when the entity you mentioned was reviewing the bar numbers, they suddenly found 2 bars with the same number, and since then the industry went through a process where everyone vetted their inventories and a substantial amount, but not substantial would be thousands, not in, it'll be 0.0001% of the total bars in circulation were found to have.
It's not quadruple nine gold, so it's material
No,
of
it was pure gold. That's what I'm trying to explain to you. It was 4 nines gold or 995 gold, depending on what was stamped on it. So it was not, but it was fake in the sense that the stamp was wrong. So let me just explain. You're right in terms of the fact that there's an issue in terms of source of gold. And that's one of the reasons why the industry, as I mentioned earlier, is so motivated to ensure that the whole process of provenance is taken care of. And that's why technologies like blockchain are being looked at, so that you can actually track a bar as it moves from one hand to another. So this is something that's a very high priority within the industry. But it's important to emphasize that there is no shortage in the gold content. It was more about the fact that the provenance, and you're right, the provenance is susceptible, and that's one of the biggest issues that the industry faces. So one needs to ensure that the industry needs at this moment to ensure that it upgrades its technology and its techniques and its policies to ensure that this doesn't happen again.
No, I think that's very clear signal, which I think is this myth has always been in the market, and well, just that everyone, some of the conspirators think that the U.S. doesn't have any gold reserve at all. So I think it's more about how you prove it and how the transactions has been done from the source of the ore to the table to the shop. So it's more blockchain technology and other kind of ways that to certify the whole process. That's more important to give the confidence to the investors that go there is go.
All right, great. Do we have any other questions?
I don't want to dominate the questions, but if nobody else wants to ask, I'll ask. You've talked about demand. You want to talk a little about the supply and what you feel in terms of reserves and the lack of finding sufficient gold for the future?
I will start a bit first then. I think you based on the so-called official numbers, there are about 53,000 tons of reserve underground. If you compare to the productions, like 3,500, you still have like 15 years of reserve. So honestly, I don't think there is a lack of gold reserve. What is lack of is what is searching by the industry is what sort of price is making it sustainable that we produce the gold. One of the reasons I think you have seen consolidations over the past 2-3 years, especially the last 2 years, is mainly because you find that the cost is rising while the prices is actually staggering or even have a risk of going down further. Until recently, we see prices coming back to 1,500. So it's more about where prices should be the right to sustain the whole industry to keep moving. And that's why I think right now, when you talk to some of these gold producers, what they do think is they're still very conservative about how sustainable the price are, because gold prices basically, I won't say it's a myth, but it's more about a functions of the confidence and the whole economy, and particularly gold is more like a currency. So this is the thing that actually difficult to have it's $1 million questions to answer. So my sense is, well, prices has to go up in order to keep the industry growing. Otherwise, you probably have the productions of mine keeping at about 3,000 to 3,500 tons a year. And when you keep this growing, some of the mines actually is going to run out. I mean, South Africa is a great example. The mine has been running out, cost is increasing. There's a lot of course, local issue to keep the cost rising. So you have the bits and pieces making the cost increase. Increasingly, you have the ESG eminence being in the formula as well. So I think the prices has to go up whether the investment demand has to come in or not. So this is the fact in my view.
In terms of supply, I will share some info on Chinese gold mining scenario, because China is right now the largest gold producing countries in the world. In the last 2 to 3 years or so, the Chinese gold production has been going down steadily year after year. The major reason is because the Chinese government has increased the standards on environmental protection tremendously. So, like for example, like they set up several environmental protection zone. And for example, if your project is in the zone or next by the zone, then you have to shut your mine down. So that's why, and then another environmental issue is about the use of cyanide because it has been classified as like toxic residue. So like people have to take extra care in order to treat the residue, and it will have to go through lots of like inspections by the supervising authorities in order to continue your operation. While lately, the most recent months, I heard that due to various reasons, the Chinese government has loosened a bit on the restrictions on the environment protection issue. So maybe some more mines will come online again, like maybe in the following 6 months or so. However, there has been a law suggested by the authorities that in China, all mining companies have to pay tax on their resources estimates under the ground. So they have to pay money, and if you don't pay, you won't get the production permits. I know that right now the whole industry is collaborating together trying to repel this tax law, and I'm not sure how long will it take or whether the government will backtrack this law or not, because obviously several like largest Chinese gold mining companies in China, they have like huge deposits in China. So if they have to pay money just based on the resource size, that is lots and lots of money.
Just to add in terms of supply, I think you should remember that in terms of above ground stocks, just a country like India has got about 20,000 tons in private hands in terms of gold. So there is talk of that the government is going to implement policies which will facilitate that gold being brought back into the system, into the financial system. There's something called a gold monetization scheme, which will encourage individuals to sell or to deposit that gold with the government. So if that policy ever becomes effective, you may see a new supply of gold, source of supply.
All right, great. Do the panelists want to have any closing statements, or should we end it there? All right. Okay, so I would like to thank the three panelists, Felix, Samson, and Sunil, for taking part today in what could be the most difficult time slot of the event. So thank you very much. Big round of applause.
Thank you.
And so